All right, so welcome to our third webinar in the series. This one will be a very exciting one. It should be about 25 minutes. I'll go ahead and get us started. Feel free to ask questions. I won't be able to see your questions as I'm presenting, but I'll come back to them at the end. So today we're going to talk about securing your future and turbocharging your retirement with insider secrets. And what does that mean? I think I've received a lot of questions. We've received a lot of questions with our current deal in Florida around using your retirement funds to invest. And I thought this would be a great way to provide us that information and get us some content to curate. So, of course, the objectives of this webinar will be threefold. The first one will be just retirement accounts, some definitions, categorizations, and real estate investing. Second, we're going to compare and contrast retirement accounts. Third, we're going to talk a little bit about advanced strategies for maximizing retirement accounts. Now, this webinar for some of you may be very basic. For some of you may use a lot of terms that you've never heard before. Our goal is just to provide the information and some resources where to go to find the right people to help you on your real estate investing journey when it comes to setup of these accounts, rollovers, 401ks, and all the bag of terms. Of course, our disclaimers are long and important. I think it's really important for everyone to know that if you are investing in real estate, you really have to do your due diligence. Market conditions can vary. Any results that we show in this webinar or previous ones may not be future results. But to be honest, on our next slide, I've really highlighted for us the key, and that's two. Number one, don't enter any real estate investment, whether it's with us or others, without really finding out what are the worst case scenarios of this investment, what could go wrong, how protected am I? Second, be wary as you're doing real estate investments, whether they are looking for an accredited investor, and we can talk about that offline. But third, and most importantly, particularly with this webinar with a lot of terms, we are not we are not tax professionals, and we are not giving accounting or tax or legal advice. You really have to consult someone before you do that. So at Apex Multifamily Capital, as well as the syndicates that we work with, we are offering you a real estate deal. We are giving you the best information. But I'm really going to try on this webinar to send you some guides and resources, books and websites that can really help you. So to understand the basics, let's dive right in. To understand the basics of the retirement account, as you all know, particularly if you are employed with a W-2 or self-employed, there are many types of retirement accounts you can have. And at least here in the United States, they often provide a tax advantage way to grow your finances as you're working so that you have them for retirement. So things we'll be talking about will be in really two buckets today. Think of it as the traditional IRA, the Roth IRA, the 401k, the Roth 401k, anything that I'm pointing to on the left will then have a counterpart or a corollary on the right, which will be self-directed. And we'll talk a little bit about what that means. There's tax advantages on both sides, but really I want you to leave this slide with the principle that it is very important to fund your retirement now, no matter what age you are. So important that you are also understanding that some of these have tax advantages and disadvantages depending on when you pay your taxes. So for example, we'll talk a little bit about 401ks versus Roth IRAs. And fundamentally, understanding these rules, whether you're doing it through your employer, and really understanding significantly how you can tax harvest in any given year is going to really impact how you're able to live in retirement. So, if nothing else, leaving this webinar and really taking a look tonight or tomorrow at the latest at what is in your retirement accounts, where do they lie? And what does that set you up for the future? I think would make us very happy if we can have you doing that. So a traditional IRA, so we're not talking about self-directed, we're just talking about the ones that you may have either if you're self-employed or a W-2, is the go-to for many savers. It's the common term that everyone knows. And in this one in particular, you're contributing pre-tax dollars, which means you're getting a tax break today, reducing your taxable income for the year. Certainly, if your employer offers this, again, depending on your tax situation and how much you can afford to put away, really maximize that. That can be a really good way to start. These investments can grow tax deferred, and they may often be a very powerful compounding tool. Now, it is not in the scope of this webinar to find out what is happening with your investments at your employer. I think that's a whole other conversation. Maybe we'll have a webinar on fees and how you understand that. But I think really getting an understanding of where your investments lie. And the idea is like, why were these set up in the United States? Well, the idea is if you're putting money away now and you're able to withdraw it later, you'll probably be in a lower tax bracket when you retire. So maybe you'll be able to pay less in taxes overall. Now, that depends very uniquely on your situation. That depends where you might be. And as I wrote here in italics, you have to keep in mind that tax brackets may change by the time you retire. Hence the conversation on making sure that you have diversified your investments. That is a term you will hear me say over and over again. Carefully, thoughtfully, strategically diversifying your investments. So now let's talk about the Roth IRA, a very different animal, but really a powerhouse for long-term savers. Why? Because now you're contributing after tax dollars. So you don't get the tax break today, but you have a really big win. Your money grows tax-free because you've already paid the taxes on it. And what that means is when you do withdraw it in retirement, it's all tax-free. You sort of know it's there and it's not going to be reduced. I think that if you're planning to continue to earn down the line and you reach retirement age, this is a very significant advantage. Personally, I think of it as follows. You've locked in today's tax rate. You may not feel great paying those taxes now, but your future self will thank you because you'll know exactly what you have. And then there's what I call the potpourri of the 401k plans. And we're not going to get into 401k, 403b, 403a, but let's just say that this is the bulk of the majority of people, particularly with employers for their retirement savings. So what is a 401k? I will presume that for the purposes of this webinar, we really want to provide these definitions and get you really clear leaving here what the terms mean. So a 401k plan is an employer-sponsored plan where you can contribute pre-tax dollars. And often your employer will match a portion of your contributions. And that match can be significant. Take advantage of it. The contribution limits often in the 401k are higher than some of the other IRAs. So if you're serious about stashing away a significant amount, this is an excellent vehicle. But as I know, many of you on this webinar or listening to this webinar later may already know all this and say, listen, I have been maximizing. What else can I do to prepare for retirement? So before we get into the exciting stuff, one last bit on comparing and contrasting retirement accounts, traditional IRA versus Roth IRA, so we get it really clear. And I don't know about you, but it took me years to get really clear on this. So with a traditional IRA, you get a tax break today because you're contributing pre-tax dollars. This can be beneficial if you want to lower your current taxable income at the end of every year, but you will be paying those taxes later. Roth IRA, very different. You're paying the taxes now. When you withdraw later, you won't owe a dime to the IRS. It's always amazing if you can legally not owe a dime to the IRS. Both of these are fantastic options for long-term growth. They want to make sure your retirement is as tax efficient as possible. However, bear in mind that the reason we're doing this webinar and really thinking about passive investing in real estate is it enough? And starting to have an idea and an understanding of what that number is that you'll need to live and live well in retirement, especially as we're all living longer, is a very important thought behind this webinar. Finally, for Roth IRAs, there's no required minimum distribution, meaning you can let that money grow for as long as you want. So that gives you a little bit more control. Obviously, we've already covered you have to pay the taxes now. So why real estate investing in this arena? So here's where things get really exciting. And I hope that you have the same reaction as this woman on the screen, which is my shocker. 2 years ago learning about how this can be done. So using a self-directed IRA for real estate investing, for example, what does it allow you to do? Well, it allows you to invest in a much broader range of assets, including real estate. What can you do with a self-directed IRA? And we will get into the nuts and bolts of how this is done. But as an overview, you can use a self-directed IRA to buy rental properties, to invest in multifamily units, to lend money for real estate deals directly from your retirement account. If this sounds crazy to you, stay tuned. So let's talk about why there's a difference between my retirement company, whatever company I'm either self-employed or my employer has set up for me. Generally, the latter is the case. What is the difference between that and creating a self-directed IRA? And I just have on the screen some of the logos of the typical companies that are generally large firms, good firms. Personally, I have retirement funds in Fidelity through my employer and Transamerica through my employer. So these firms typically allow you to invest in stocks, bonds, mutual funds, and CDs. And the way they make money, and this is another long conversation, is the buying and selling of these financial products. And they're generally not interested in offering you private real estate deals, for example. But I do want to point out in this webinar, there's no limitation. If they wanted to, they could also get in this game, but that is not fundamentally what their business model is. So while the IRS places no limitations on Fidelity or Vanguard, for example, doing similar investment as the private placement deals, it's not something that you often see. So enter this arena of these self-directed IRA companies that allow you to do some very interesting investments. Real estate purchases, private placement memorandums, we'll talk about that, syndications, land deals, LLCs, and cryptocurrency as examples. What are you not allowed to do with self-directed IRAs? And this list is by no means comprehensive, but at least you're not allowed to do life insurance contracts. You're not allowed to collect cars or gems or stamps or your grandmother's coin collection and be putting all of those funds in there. Now, this webinar is really focused on the first line under self-directed IRAs, which is real estate purchases and private placement syndication. So let's focus on that. What you need is great companies to help you do this. And these are companies you may or may not be familiar with. I have placed that there's IRS guidelines and a publication for those of you that need some bedtime reading for prohibited transactions to keep you out of trouble. So let's talk about the types of self-directed plans that these different companies offer. The first one is, look at that. I've taught you IRAs. We've talked about traditional IRAs. We've talked about Roth IRAs. We haven't talked about SEP and simple IRAs, but you have to be self-employed to be eligible, which some of you are, and inherited IRAs, a best case scenario that someone hands you a bunch of money and there are very strict rules of distribution. But we will really focus on traditional and Roth here. Another type of self-directed plan is a solo 401k. Very specific rules around this. You have to be self-employed with no other full-time employees, but you can make higher contributions. You can take a personal loan against a self-directed solo 401k, and it has some different tax implications. And while we won't cover UBIT and UDFI taxes on this webinar, I think that's one of the reasons that you need a tax strategist as well as a great company that you're working with for a self-directed plan to better understand it. So you can see as I start to lay this out that the self-directed traditional IRA and the self-directed Roth are going to offer some significant benefits. Another one to really discuss, and in the future, we may cover this in detail in a webinar with a colleague of ours that we work with, is health savings accounts. So high deductible insurance medical plans, you can put money aside, and these can be a great way to grow money tax deferred as well. Again, we don't have time in this webinar, but I want to leave you with this slide so that you have some terms to look up. So here's some examples on the right. Personally, I have used directed IRA. I have many friends who have used equity trust, and currently I refer a lot of people to Quest Trust Company simply because of their excellent service. So now you might be asking, okay, you've thrown a lot of terms at me. How am I going to use a self-directed IRA? What are the nuts and bolts of what I need to do? First, identify a company and open a self-directed account. That will be called a self-directed IRA, for example. Second, take the money, and here's where the terms matter. You are rolling over your money from, for example, what I did, from my Fidelity 401k into my self-directed IRA. Next, which company should I use? Reiterating, these are three. These are not the only three. These are just the three I'm very familiar with, and they are big in the industry. So you've picked a company, you've opened an account, you've started to roll the money. I will say it again, our favorite is Quest, and that's just because of customer service. There is no financial relationship between Apex Multifamily Capital and Quest. Next, you've got the account ready. You've got money in there. Where should you put it? Well, very carefully, as we said at the beginning, identify a real estate investment. Remember that the self-directed IRA is really the buyer or the investor. So I, Ayesha, am not investing in a property. My self-directed IRA, which generally comes in the name of self-directed IRA, Ayesha, Khalid, FBO, so it has a long name and it has your name in it, for example, becomes the owner in the property or the fractional owner, in our case, in multifamily real estate. Sign the private placement memorandum, which is the document that we use in a lot of our investments. Now, here's where it gets interesting. On the investment side, you have signed something that says, I, Ayesha, want to invest in this property. Here's how much money I'm putting in, but I am investing with the name of my self-directed IRA. Do not forget on the other end to submit a direction of investment on one of the sites of these companies that you are using. That tells, for example, directed IRA, Ayesha is looking to use her self-directed IRA into this investment. Please go ahead and submit it there. Now, are they just going to do this right away and just trust you and send the money over? That would not feel secure. And I know a lot of you are wondering what protections are in place. By using these companies before the wire money is wired, let's talk about the last point, then we'll come back up. Directed IRA and Quest Trust will say, please, we need to see the operating agreement and the subscription agreement for this property, which generally might be found either separately or within the private placement memorandum. Once we see that it's legitimate, it has all of the components, the SEC information, the investor information, who's the sponsor, where's the location, et cetera, then we will go ahead and say, we will handle as the company the transfer from the self-directed IRA account directly to the investment. So that is how the ACH or the wire transfer is done. Now, some of you have asked in the past, what does this mean about when I get my return on investment? Well, that return on investment is not coming to my pocket and I'm not able to go plan a trip with it. That investment is coming back to the self-directed IRA account. So you didn't pay taxes when I rolled the money over from Fidelity. I was able to put it into a self-directed IRA. I was able to prove, for example, to directed IRA that this was indeed a legitimate investment. They indeed asked me, I would like to see the operating agreement, the subscription agreement. Once it was verified, they went ahead and wired the money from my self-directed account directly to the investment. When the return on that investment comes back, it will come back into my self-directed account. Here's the beautiful part. It means that my retirement funds will continue to grow in a very different way. I did put in here that there are many IRS rules with everything that I'm saying, and be very clear that as these investments, they should not be connected to you or your direct family member. So there are some disqualifications of what you can fund with a self-directed IRA. Some of you may read about a checkbook IRA. What does that mean? So you can, if you want to, establish a self-directed IRA that invests in an LLC specifically created for the IRA's investment. In that case, you would be creating a business checking account for your LLC That business checking account would be in the name of your self-directed account. The custodian, again, example, directed IRA or equity trust, would receive the funds from your traditional IRA. Let's pick on Fidelity again. It would say, okay, I've gotten the funds. I'm going to put them into your business checking account. And then Ayesha, can really control where this investment is going and how much I'm doing. I don't have to wait for one of these companies, for example, to do it for me. There are some downsides. I would recommend that people really look at whether we, as the investor, have the control or the company has the control. Sure, if I have funds in my business checking account, I am able to just write the check, but I'm really losing that level of protection of the review of the operation and subscription agreements. I'm really having to put the burden on myself to make sure everything complies with IRS regulations and the need to review all of them. And there may be more fees involved with having this autonomy. So we just put it here. I want you to know about it. I want you to know it exists. I generally find that investors that are savvier are ones that tend to have a checkbook IRA. So growing the pot. What does this mean? Let's do a case study. How has this been used? So if an investor, and this is a true story, uses her self-directed IRA to purchase private real estate with an investment in a multifamily, someone we know did this years ago, $200,000 total to invest over 5 years. Let's say she gets a 2x return. She indeed had $400,000 coming back to that self-directed IRA. We're not putting in there the tax implications. We're making some assumptions that she consulted a tax professional. That property was sold. The money was deposited back into the self-directed account. You potentially have now doubled your money. You're reinvesting that into 2 other deals right away. 6 years later, and again, it's hypothetical, these examples. I don't know what your returns will be, but you've now doubled your $400,000 to $800,000, tax-free, again, within the limits and regulations of the IRS. She did it 3 more times by the time we met her. So she consulted with a tax strategist and a tax professional. You will see in this webinar that there are so many investors that I meet that have not done that to really understand both the tax filings as well as the tax harvesting. But I want you guys to really see the numbers, 200 to 400 to 800, and she's doing this for the 4th time. These are not the funds that are what I would call her operating cash flow. These are from her retirement funds. So by the time she retires, in her case, 24 years later, that one property she invested in has led to multiple investments in property, and all have grown significantly in her self-directed IRA. To receive funds from that, she has to reach the age of 59 and a half, with the additional caveat that if this was a Roth IRA, which it's not, that the account has been open at least 5 years. But we assume that as she is building her wealth through real estate, this has allowed her to grow her retirement significantly without paying taxes on the gains along the way. Now, of course, as you study this and you think about this, the implications of this are so different than other things that we do with post-tax money that are not in retirement. This is a human that I know and love. He has been very helpful, and I decided today and asked him earlier to just send me his information. I think there are probably a slew of professionals that know about self-directed investments. I find that Chris is responsive, knowledgeable, really understands the types of accounts, and is at Quest Trust Company. So I put his information here. It'll be in the webinar. And if nothing else, you can book a call and just learn how all of this works with a lot more detail than I provided today. What about reading? As many of you know, some of my favorite books are on here. I think everyone should read Unshakable. Everyone should get Holy Grail. But guess what? Everyone should also say, is passive real estate investing for me? The first rule should be, what is your pie chart? How are you allocating your assets? Perhaps, like you were 100% with money in the market, either through a money market account or a 401k that was investing in the market through your employer. Should that be allocated differently and have some alternative or private investments? Those are the decisions you have to make first. Second, a principle that comes up often, PYF, pay yourself first every month in your paycheck, in your spending plan. What percentage are you going to put away for future you. And these books cover those concepts. And then maximize. I am not opposed at all to really maximizing your 401k and your employer match programs. But after you do that, do something that is even more important, which is tax harvesting. So for all of us on this webinar, finding out what are the legitimate ways with a tax strategist. Some of you, many of you have shared that you have an accountant or a tax professional, a CPA that files your taxes. I think it is life-changing to also have someone within the firm that is your tax strategist, maybe does a once a year meeting to say, what can you do in terms of depreciation from a real estate investment? How would that impact your taxes? And then I have YouTube, because honestly, in this day and age, the amount that you can learn by just educating yourself, we have no lack of information, and sometimes no lack of good and bad information. So I think that, some of the companies I mentioned, some of the resources on our website, just places you can go to see what else you can do. At this point, thank you so much. I'm going to take any questions and stay tuned for our next webinar. And at this point, thank you so much for attending, and I'm going to go ahead and stop the recording.